Chapter 8 deals with accounts receivable and notes receivable. Most businesses will sell their product and or service on account. Of course, this means that in return for a promise to pay for a service or product, the customer will receive the product or service and then will pay within 30 days. This is a common business practice, and these types of sales are made on a regular basis. The terms of a sale on account are typically 30 days, and many companies will offer a discount, 1 or 2% discount to a company if they would pay within 10 days. This is actually a good move on the part of the company so they can get their money faster. While accounts receivable is kind of an unsecured debt of the customer, sometimes if we're not familiar with the customer, if we're not satisfied with the fact that they haven't paid us yet, we may attempt to convert an accounts receivable to a notes receivable. This simply means that it's a written instrument now, and there is some collateral or some security now associated with that debt. This chapter also deals with receivables that may go bad. In other words, bad debt expense. We expect our customers to pay us, but this does not always happen. As a result, in the accounting transaction, we have to account for bad debts. There are two ways to do this. One is called the direct write-off method, where we write accounts off as they go bad. This is the IRS required method. The other method is the allowance method, where we estimate our bad debts based on our history, and we will make a journal entry at the end of every accounting period estimating what we think our bad debts might be. This is GAAP required accounting. Finally, in the chapter, we discuss how receivables show up on the balance sheet. Accounts receivable will show up as a current asset, and the accompanying allowance for doubtful accounts, which is a subtraction from accounts receivable, will also show up on the current asset section of the balance sheet.